Alright, let's get straight into it. This video is going to walk you through the one concept that actually moves the market: liquidity. Most traders don't get stopped out because they're wrong. They get stopped out because they're too predictable. So in this video, I'll show you exactly how to find liquidity, how to track it, and how to use it to get positioned on the right side of the move. This is the first module of my crash course, which will help you understand and focus on the only concepts that matter. Let's break it down. Liquidity is not about volume. It's not about volatility. It's about where price is designed to go, to trigger orders at clean highs and clean lows. That is where the retail stops are hiding. It's not about your stop. It's about the area where everyone else are most likely to place theirs. That's what the algorithm targets, and that is liquidity. Theoretically, liquidity lies above and below every swing point. So what is a swing point? A bullish swing is a 3-candle pattern that has a higher low to the left and a higher low to the right. A bearish swing is a 3-candle pattern that has a lower high to the left and a lower high to the right. But practically, price does not target every one of these swing points. You need to understand which ones are valid and which ones are not, and that is what I will teach you in this video. We can consider these highs and lows to be external liquidity, and this is where price reverses or retraces from. Let's take a look at a few examples. This is the Euro USD daily chart. As you can see, the relevant swing high is this external high and this external low. The only other external low is this one. Let's see how price plays out, and we have a very nice external high presented as well. So once price takes either the low or the high, then we can engage in price. As you can see, we have taken out this external low and we have a nice close above this opening price. This means that on the next candle, we can be bullish, targeting this external high. This is where you would position yourself, and that is the objective met. Now, once this external low and high has been taken, you should wait for another swing point to form. And there we have it. We mark out the swing high and the swing low. And this is a new external high and new external low. This is also called as a dealing range. Now you want to position yourself in the direction in which you believe price is moving to target next. Is price going to take out this external high, or is it going to take out this external low? Price took out this external high, and now the new external low is this low right here. Mark this out, and now we wait for an external high to form. Right here, we have an external high as well. Now you want to see price close above this external high. That gives us the validation that we'll move towards this high. So we're still inside the range, and we're marking out the external liquidity pools inside this range. So now you want to see if price closes above this high, the next objective would be this external high. And this low would be the invalidation for this move higher. Price has taken out this external high and closed above this external high as well. This means that we can now be bullish and be confident that price is going to target this external high next. And there we have it. You only need to track two concepts on your chart. One, highs and lows. These are your swing points. Two, fair value gaps. These are your internal liquidity pools. These are areas where price moved fast and left an imbalance, and price wants to come back and fill them. So what happens? Price trades liquidity outside the range. and then pulls back inside to rebalance. That is your framework. I will go into more detail around this concept in a further video. So which liquidity pools will price take? Before we get into that, let me explain the importance of engineered liquidity. The algorithm builds liquidity right below an external high to trick traders into thinking a retail short pattern is in play. And then it takes them all out aggressively. What we do is use this information to our advantage. We watch those levels to form as equal highs and equal lows. And once that's done, the probability the price takes the external liquidity increases. At this point, we are clearly counter trading the retail patterns, and it works really well. Let me show you an example of this as well. We're on Euro USD 1 hour chart. We have our external low and external high plotted, and we want to see price take out one of these levels before engaging in price. We also want to see price engineer liquidity right above this low or right below this high. So let's see what price does. At this point, we want to see price take out this external low before engaging. Price tends to move higher, forming equal lows with this low and this low. This is engineering liquidity. And retail would see this as a triangle pattern and wait for a breakout to trade. As you can see, a retail triangle pattern has been formed here. And they would be waiting for a breakout to position themselves. And there we have it. We have the external low taken aggressively when we have equal lows present. At this point, the retail pattern traders want to position themselves short, but we'll be looking for long positions because we have taken out an external low. And there we have it. We have an aggressive move to the upside, taking out external high with equal highs formed with these lows. Every aggressive move in the market is accompanied with one of these equal lows or equal highs. So where do these price hunts and liquidity sweeps usually happen? The three levels I always track are previous day's low, previous day's high, previous week's low, previous week's high, and previous month's low and previous month's high. These are not just random levels. These are targets, and they act as magnets in price. You will see price push into these areas, trigger stops, and then reverse. Let's look at a few examples. Here on Euro USD 1 week chart, I have marked out the previous week's high and the previous week's low. The context behind this is price has expanded higher, and we want to see either a retracement or a reversal. Let's drop down to the 1 hour time frame. And now we want to see price take out this previous week's low, which is the external low, or we want to see price take out previous week's high, which is the external high. Once price does that, then we can position ourselves in the opposite direction. Also look out for these equal lows and these equal highs. Let's see what price does. Price has taken out previous week's high, and now we want to see a market structure shift or a change in state of delivery to target lower prices and these equal lows. Also look at how price aggressively moves into this external high because the equal highs present. As you can see, we have a clear aggressive move lower, giving us a market structure shift below this low. You can position yourself short with your invalidation above this candle. And price moved lower, and we have these equal lows here. Price has some form of reaction there. We also have these lows and this previous week's low as our external liquidity pool. price almost takes out this external low, but retraces a bit. This usually happens because price has taken out these equal lows. And eventually, we reach our objective. First, let price hit a known liquidity level. This would be step 1. It could be a high or it could be a low. Then step 2 is you wait for a market structure shift, or you can also wait for a fair value gap after the liquidity sweep. Then you enter away from the sweep and target either the internal liquidity pools or these equal highs or equal lows. Remember, you're not chasing any trend, you're fading manipulation. That is the key difference. Liquidity is the one constant in the market. If you understand it, you move with the algorithm. If you ignore it, you'll keep being on the wrong side of it. So next time you get stopped out, ask yourself, did I trade in the direction or did I become the liquidity? If this helped you, drop the word liquidity in the comments and let me know if you want the second part of this course out there. Do like the video and subscribe so you don't miss out on the next module, and I'll see you in the next one.